The American walking off this plane in Dubai is about to owe the IRS $22,000, and the Dubai address is going to be completely irrelevant. That is where we are going. 6 countries do not tax personal income. If you're American, that almost never means what you think it means. The Internal Revenue Service follows your passport, not your apartment. Move to the UAE, move to Panama, move to Paraguay. The agency still expects a return every April. So in this video, I'm walking the 6 countries that genuinely run a zero tax or territorial tax system, the actual entry cost in 2026, the foreign earned income exclusion ceiling of $132,900 you need to know before anything else, and the 3 U.S. obligations that survive the move. Stay through to the end. The $22,000 obligation most people miss does not care what country you live in. Things changed in 2026 that make older guides on this topic effectively obsolete. 1. The IRS just handed every qualifying American expat a $2,900 raise. The foreign earned income exclusion limit jumped from $130,000 to $132,900 per person, the largest single-year dollar increase on record. 2. Portugal's old non-habitual resident regime, which expat creators promoted for a decade, officially closed for new applicants in March of 2025 and was replaced by the much narrower IFICI program. 3. Paraguay launched a brand new investor pass at the end of April that drops the direct permanent residency cost to around $70,000 US. 4. Panama's Friendly Nations visa, which used to be a cheap territorial tax play, was restructured and now requires a $200,000 investment to qualify. If you watched a video about this topic published in 2024, you watched a different country list with a different cost structure. This is the 2026 version, the part most YouTube videos on this topic skip. The United States is one of 2 countries on Earth, the other is Eritrea, that taxes its citizens on worldwide income regardless of where they physically live. You move to Dubai, you keep filing a U.S. return. You move to Panama, you keep filing a U.S. return. The foreign earned income exclusion lets a qualifying American shield the first $132,900 of earned income in 2026. Above that ceiling, you owe normal U.S. federal tax brackets. The exclusion only covers earned income, salary, wages, self-employment net. It does not shield dividends, interest, capital gains, or rental income. And to qualify for the exclusion at all, you need to either be physically outside the United States for 330 full days in any 12-month window, or establish bona fide residence for a full tax year in a foreign country. Both tests are stricter than most channels imply, so when a video tells you a country has no income tax, the honest follow-up question is, for an American, the income tax of which country? Country 1, the United Arab Emirates. Personal income tax in the UAE is 0, not low, not territorial, 0 for residents and non-residents alike. There's a federal corporate tax now for businesses above 375,000 dirhams in profit, but the personal side stays clean. The route most Americans use is the 10-year golden visa through real estate investment, and the threshold in 2026 is a property worth at least 2 million dirhams. That's roughly $545,000 US at the current peg. You can combine multiple title deeds to hit the 2 million dirham total, and mortgaged property qualifies as long as your bank issues a no-objection certificate. The visa renews automatically, covers your spouse and children, and there is no minimum stay requirement to keep it active. Realistic profile this country fits: a remote working American earning above the FEIE ceiling, or a business owner who can park $500,000 in Dubai real estate and is happy treating it as both residence and asset. If you're trying to do this on under $200,000, the UAE is not your country. Country 2, Panama. Panama runs a territorial tax system, which means foreign source income is not taxed locally, even if you deposit it in a Panamanian bank account. The route Americans usually take is the Friendly Nations visa, available to citizens of around 50 qualifying countries, including the United States. Here's what changed. Until 2021, this was practically free. A small deposit and a local connection could get you provisional status. The current 2026 framework requires one of three qualifying paths, each pegged at roughly $200,000. Path 1, invest $200,000 in Panamanian real estate. Path 2, deposit $200,000 in a Panamanian bank for at least 3 years. Path 3, secure formal employment with a Panamanian company through a Ministry of Labor work contract. Provisional residency lands in around 72 hours after filing. Permanent residency follows after 2 years, and the visa covers spouse, children under 25, and dependent parents. There's no annual minimum stay. You only need to enter Panama at least once every 2 years to keep the status alive. Realistic profile this country fits: an American whose income is mostly foreign-sourced and who is comfortable parking the $200,000 somewhere defensible. Tree 3 is the one that just opened up, Paraguay. Until April 2026, Paraguay's old direct residency path was a $5,000 bank deposit, and that route was removed by Law 6984 back in 2022. What replaced it, effective the 28th of April 2026, is the Investor Pass, and that's the headline. Direct permanent residency, valid 10 years, from a minimum investment of $70,000 across 4 qualifying tracks: operating business, real estate, financial instruments, or qualified tourism projects. That is the cheapest direct permanent residency price tag in this entire list. Tax-wise, Paraguay is territorial. Foreign source income is not taxed locally, the same structural treatment as Panama. The catch is the passport and the language. The Paraguayan passport is mid-tier in terms of visa-free access. Spanish is effectively required, and the infrastructure outside Asunción is uneven. Realistic profile this country fits: an American with foreign source self-employment income who wants a cheap, clean, territorial tax residency without parking $250,000 up front. Tree 4 is the one almost nobody in the American expat finance crowd talks about correctly. The country of Georgia in the Caucasus, not the U.S. state. Georgia runs a strict territorial tax system. Foreign source income, remote work for non-Georgian clients, foreign investments, foreign pensions, is 100% exempt from Georgian income tax, even when paid into a Georgian bank. Georgia-sourced income is taxed at a flat 20% rate. The residency on-ramp is the simplest in this list. Spend 183 days inside the country during any rolling 12-month window, and you become a Georgian tax resident automatically, no investment required. The hidden gem layer is the individual entrepreneur small business status. If you register as an individual entrepreneur and your gross annual turnover stays under 500,000 Georgian lari, that's around $185,000 at the spring 2026 exchange rate, you pay 1% on gross turnover. 1%. Realistic profile this country fits: a freelance American contractor or solo SaaS founder grossing under that threshold who can spend 6 months a year on the ground. The trap is that the Revenue Service tightened documentation requirements this year. You need clean evidence that the work was actually performed for non-Georgian clients. Tree 5, Malaysia, through the Malaysia, My Second Home program. Malaysia also runs a territorial tax system at the personal level. Foreign source income remitted into Malaysia is not taxed for individuals through at least the end of 2026 under current rulings. The mainland MM2H is now structured as 3 tiers: Silver tier, a fixed deposit of $150,000, and a compulsory property purchase of at least 600,000 ringgit. Gold tier, $500,000 on deposit and 1 million ringgit minimum on property. Platinum tier, $1 million on deposit and 2 million ringgit minimum on property. The property purchase is now compulsory and must close within 12 months of MM2H approval. That's the structural shift most older guides miss. The old monthly income test was removed. Realistic profile this country fits: a higher net worth American who wants Kuala Lumpur or Penang as a base, can absorb the dual fixed deposit plus property entry cost, and treats the property as both residence and asset. If you cannot park 600,000 ringgit in real estate inside the first year, MM2H is not your route. Country 6 is the one I have to cover as a cautionary tale rather than a recommendation: Portugal. For roughly a decade, the non-habitual resident regime, NHR, was the default European answer for tax-aware Americans and EU pensioners. 20% flat tax on Portuguese employment income, most foreign source income exempt, 10 years of runway. That regime officially closed for new applicants in March of 2025. What replaced it is the Innovative Fiscal Incentive for Scientific Research and Innovation, IFICI, and the design is deliberately narrower. To qualify, you need to become a Portuguese tax resident. For the first time after January 2024, you cannot have been a Portuguese tax resident in the previous 5 years, and you must hold a European Qualifications Framework Level 6 degree with at least 3 years of relevant professional experience, or a Level 8 degree such as a PhD. Qualifying activities are tied to specific high-skill sectors: science, technology, healthcare, green energy. Pensions are no longer exempt. That's the line item that ended the regime for the retiree audience. Realistic profile this country fits in 2026. A credentialed American researcher or specialist taking a job inside a qualifying sector, not a remote worker, not a retiree. If a creator is still promoting Portugal NHR for retirees, they are promoting a regime that does not exist. This is the section to watch if you only watch one. The foreign earned income exclusion shields your income from U.S. federal income tax up to $132,900 in 2026. It does not shield your income from U.S. self-employment tax. Self-employment tax is the combined Social Security and Medicare contribution that anyone filing a U.S. Schedule C owes on their net business earnings, 12.4% for Social Security on the first $168,600, and 2.9% for Medicare with no ceiling. Combined, 15.3% on net business income. The FEIE does not touch it. Moving to the UAE does not touch it. Moving to Panama does not touch it. The only structural relief is a totalization agreement between the U.S. and a small list of countries, primarily in Europe, plus a handful of others. None of the 6 countries in this video have one, so a freelance American grossing $150,000 net from foreign clients while living in Dubai still owes U.S. self-employment tax on the full amount. That obligation does not care what residency card is in your wallet. This is the line item nobody covers, and it's why the answer to "should I move to a zero-tax country" depends almost entirely on whether your income is salary, self-employment, or capital. Second obligation that survives the move is state level. When you leave the United States, 4 states are notoriously aggressive about treating the exit as incomplete unless you sever ties with clinical precision: California, New Mexico, Virginia, and South Carolina. These are the sticky residency states. Their default position is that you remain a state resident for tax purposes until you affirmatively prove otherwise, by closing bank accounts, switching driver's license, ending homestead exemptions, moving voter registration, and in some cases physically severing for a full calendar year. California in particular looks at 20+ separate factors and a single retained tie, a storage unit, a doctor relationship, a paid utility account, can be cited as evidence you never really left. The cleaner exit states are Florida, Texas, Nevada, Washington, South Dakota, Wyoming, Tennessee, and Alaska, the 7 states with no personal income tax, plus New Hampshire, which has no tax on wages. If you're moving abroad from one of the sticky 4 without a proper severance plan, the state can issue assessments years after you're gone. This is the obligation that hits long after the federal side is settled. The decision tree based on the math we just walked. If you already know your income type, jump to the row that matches yours. I'm going to go through all 4, but experienced viewers can use the chapter markers to skip directly to salary, self-employment, capital, or retiree. If your income is primarily wages from a foreign employer, the FEIE covers you up to the ceiling, and your best matches are Georgia under the standard 183-day rule, Panama through friendly nations, or Malaysia if the dual deposit plus property entry cost fits. If your income is primarily self-employment, the FEIE shields federal income tax, but the self-employment tax follows you everywhere so the cheapest entry options, Paraguay's investor pass at $70,000, or Georgia's individual entrepreneur regime at 1% on gross to roughly $185,000, give the strongest cost-to-benefit ratio. If your income is primarily capital, dividends, capital gains, business distributions above the FEIE ceiling, only structural moves help, and the realistic playbook is UAE Golden Visa territory, with serious advice from a cross-border accountant before signing anything. If you're a retiree on Social Security or pension income, none of these countries shield the U.S. tax on that income. Portugal's NHR used to, and that door closed in March 2025. And if you're moving abroad from California, New Mexico, Virginia, or South Carolina, the state exit work has to start before the international move, not after. Pick the country that matches the income type, not the country that matches the postcard. Which income type are you working with? Salary, self-employment, or capital? That single answer changes which country wins for you. Drop it in the comments. That's the honest 2026 math. At the top of this video, I told you the passport is a $22,000 tax bill if you pick the wrong country. That was the self-employment tax. And the math is the same no matter which residency card is in your wallet. 6 countries with no personal income tax on foreign source earnings: UAE, Panama, Paraguay, Georgia, Malaysia through MM2H, and Portugal as a postmortem. 3 obligations that survived the move: federal income tax above the FEIE ceiling of $132,900, self-employment tax regardless of address, and state-level exit risk if you're leaving California, New Mexico, Virginia, or South Carolina. None of this is tax advice. It's the math you walk into a cross-border accountant's office already understanding, so the conversation starts at a real question instead of a sales pitch. So which one are you? Salary, self-employment, or capital? That single answer changes which country wins for you. Tell me in the comments below.